Hey there, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a rainy Redmond, Washington. It's Tuesday, and as we wrap up today's session here in the meat of earnings season, the risk assets moving higher for the most part. The S&P, the NASDAQ having a pretty decent update, although it was choppy and quite squirrely there earlier in the day. Now, even though the major benchmarks have moved higher underneath the hood of the market, a lot of differentiation between stocks leading to the upside, stocks leading to the downside. Consumer staples, one of the most defensive sectors out there, actually finishing at the top of the leaderboard. So as much as we want to think about new all-time highs as a very bullish sign, which generally speaking they absolutely are, let's make sure we focus on the evidence underneath the hood. Look at breadth conditions, look at particular stocks gapping higher and lower, particularly during earnings season. This could be one of the big catalyst for the market to move further to the upside or start to retrace some of those previous gains. With that in mind, let's get to our market recap and focus on how things evolved during the course of the day today. I do want to start with a poll question. Did a bit of a technical analysis quiz for you this time. What makes the Ichimoku cloud model so unique? It's plotted 26 days in the past. It's plotted 26 days in the future. It's plotted without the price, or it's plotted upside down. Correct answer is number 2, or B. It's plotted 26 days in the future. It's actually one of the more unique technical indicators out there. It's a traditional Japanese form of technical analysis, and I read a book about this, or an ebook actually. This is before there were any books in English written on the Ichimoku cloud, and saw someone that had translated some literature talking about this cloud model, and really is unique in that it has part of the indicator plotted 26 days in the back. The cloud portion of this complete model is plotted in the future, and then there's some other things kind of coincident. And the idea of this model is that you'd use all of them together, and using all of those components to understand different parts of the trend and momentum characteristics. We have a great article, by the way, on our Chart School page. If you just hit the little magnifying glass in the upper right corner, type Ichimoku, which is how you spell it right there on my screen, or just cloud, you'll get to this article, which really goes through the different components to it, how you can use it to understand the trend characteristics. And if you want to know how to actually use it, when I've had interviews with someone like Katie Stockton comes to mind, is one of the prominent technical analysts in the industry these days that uses the cloud model regularly in her work. So if you go to some of my interviews with Katie, you'll see the cloud model used in practice, how it can be used to anticipate, again, forward-looking potential areas of support and resistance going forward. So correct answer was B, plotted 26 days in the future. Chart School, by the way, a great way to learn more about technical analysis if you're just getting started. Let's apply that technical toolkit to the market today here as we break down today's action. The S&P 500 finishing up about 0.33%, 0.3%, to just below 48.65. And to be honest with you, most of those gains came in the last 90 minutes of trading. Up until around 2:30 Eastern, it was kind of a choppy sideways day. And as you'll see when we get to some of the individual stocks, you'll see some stocks that gapped higher and a bunch of things that gapped lower today on earnings. So a lot of different movements to try to reconcile. At the end of the day, the S&P finishing higher, the Dow finishing 0.25% lower, the NASDAQ composite leading the way higher, 0.4% to the upside. So you'll see growth over value continuing to be one of those themes that really dominated 2023. So far, early days of 2024 continuing to be a thing. Mid caps and small caps actually both down. So the S&P small cap 600 index down about 0.6%, and that's of course relative to the S&P large cap finishing higher. So large over small, again, referenced also part of this general theme of the markets, with the largest names outperforming some of the smaller names. And the biggest breakouts we're seeing in a lot of ways, those mega cap growth names like Meta and Alphabet and others. Volatility remains relatively low. Today, by the way, we have a really good guest, Ari Wald of Oppenheimer, one of the best out there, does a really good job working with institutional investors on how to think about technical analysis and charts relative to all the other conditions that we can assess as investors. You know, we'll talk a little bit with Ari about the VIX. VIX remaining relatively low, right, at a 12 handle, meaning 12.6 or so. You know, volatility remaining low in an uptrend is kind of a normal, slow and steady bullish phase. That's pretty common for a market in any bullish trend, which means one of the things I would be looking for is a spike in the VIX. A VIX above 14, 15 would be, things might be getting weird. A VIX above 20 is where things really start to get dangerous. We are nowhere near these levels. To be clear, S&P, basically making another new high with volatility remaining low. This is a bullish market as defined by trend and volatility. Now, interest rates through the course of the day today moving higher. The 10-year yield around just about 4.1%, we'll call it. 5-year yield just below 4.1%. Long bond yield just below 4.4%. Now, of course, the short end of the yield curve still remains fairly elevated. So we do have that inverted yield curve, which has been in place for quite some time here. I can't remember the last time we did not have an inverted yield curve. That's how long I've been reporting on that. As yields are going higher, that means bond prices are going lower. So the TLT, which is a Treasury bond ETF we like to track, down about 0.8%. The dollar slightly higher, about 0.25% higher today. Looking at the commodity space, more green than red. The broader commodity markets, as defined by the DBC, which is a commodity ETF, up about 0.5%. Gold and silver prices both higher, with the SLV up 1.5%. Copper prices pushing to the upside. Crude oil essentially flat. And the energy sector is still nowhere near the top of the list. We'll see some of the energy stocks reporting earnings here. Halliburton was one of the names coming in the last 24 hours. We'll review that one for sure. Finally, cryptocurrencies all in the red. We continue to see sort of a risk-off move from Bitcoin, from Ethereum especially, which is now back below 2,200. Bitcoin now below 40,000, down to around 39,100. Down about 1%. So again, from the moment that the Bitcoin ETFs were finally approved and reported and started to gather assets, Bitcoin, that's been the high watermark for Bitcoin. It is, if you're ever looking for a great example of buy the rumor, sell the news, that is it. I think the chart of Bitcoin over the last couple months. And again, that general philosophy, that market maxim, if you will, is the idea that the markets are a forward-looking mechanism, right? So when there's an idea out there that might happen and investors have optimism that's going to happen, prices start going higher in anticipation of that news actually occurring. By the time the news actually comes out, the markets have already gone up and have discounted that success. So when the moment happens, that's when you probably want to sell. That's when that trend is probably over, because the optimism's already been baked in. So the fact that the ETFs actually were released were already priced into the value of Bitcoin leading up to that announcement. So at some point, I would anticipate Bitcoin finds a footing. We'll look at that chart here in a few moments and try to identify some of those levels together. Finally, looking at sectors, not a great day for offense in only the fact that staples, consumer staples, one of the more defensive sectors we could identify was at the top of the list, up 1.1%. The XLC communication services number 2, and then technology number 3. So some growthy sectors there at the top for sure. Real estate, consumer discretionary, industrials, healthcare, all in the negative. Real estate leading the way lower, down about 0.5% from previous day's close. Let's go to a daily chart of the S&P 500, and as we talked about, right? I mean, from a trend-following perspective, the trend is positive, right? Charles Dow, if he's alive today, looks at this chart, probably be thrilled by the technology we have to use charting, because he was doing it all by hand back in the day. But if you look at the stock charts, the daily S&P 500 chart, we're breaking out, right? And the most bullish thing the market can do is go up. Legendary technical analyst Paul Montgomery famously said those words a number of years ago, and that's where I think we're at, right? So the S&P making higher highs, making higher lows. As long as that trend continues, the market's going higher, right? The trend is up, and I have learned to follow trends, to follow the momentum until proven otherwise, and I'm not seeing that being proven otherwise. The S&P just narrowly overbought again at today's close, just slightly above that 70 level. And that's been one of the, I guess, questionable characteristics of the market here in January, is new highs in December were mostly overbought. The RSI here for the S&P 500 got above 80 the third week in December. That's just before the holidays. And then you saw the pullback, and then on previous or on subsequent rallies, that is, you saw the RSI much, much lower. Now all of a sudden we're getting back to that overbought condition. So when you do have divergences like this, the way that you negate those, the way that you reiterate a bullish thesis according to the momentum, is that the RSI gets back above that overbought condition, pushes higher, right? We want higher prices on stronger momentum. That is that is what a bull market looks like. And an example of that, I want to say Alphabet. Yeah, so Alphabet is one of those names, making new 52-week highs this week. The RSI not even overbought yet. So a lot of names in December were very overbought, and all of a sudden not so much here in January, which those divergences are concerning. Something like Home Depot is a great example of that phenomenon. Higher highs in price, lower peaks in momentum. And there are a lot of names that fit that category. I would much rather be in names that are not showing that divergence. Alphabet is an example of one of those leading growth names, really not showing any divergences, really just showing continued strength and in trend and also strength in momentum. I want to show just briefly a couple charts before we get to some individual stocks. We're kind of in the meat of earnings season, and when we're in earnings season, I like to focus more on individual names because that's where you find a lot of actionable moves. Before we get there though, I do want to talk about interest rates. Here's the 10-year yield. You can see from 5% down in October down to late December, around 3.8%. Here in mid-January, late January almost, we got up to 4.2%. You know, rates going higher, you know, in general, that tends to be a risk to growth stocks because higher rates don't tend to be particularly strong for growth. Growth stocks not getting that memo at all, though, because if you look in January, it's been growth over value, which was the theme for much of 2023. We're seeing that continued here, and you can see that at the bottom. This is the relative performance of value over growth, and you can see that in the last couple of weeks, it's actually been sloping downwards, even though interest rates have been going higher. Now, I would argue if you see rates continue to push higher, if you see 10-year yield above 4.25% to 4.5% or more, I would be surprised if you don't see value stocks start to do a little bit better on a relative basis, given that rising rate environment. But for now, still growth over value by any way I would slice it, and on most timeframes I would probably care to share with you. Let's look briefly here at Bitcoin, Ethereum, both kind of coming down in a pretty big way. And again, if you want to know what happened here at the turn, that's when the Bitcoin ETFs finally approved. From there, it's been straight down. Now, not surprised that Bitcoin topped out there because from a technical perspective, sort of a confluence of resistance. We talked a little bit about that. I think on yesterday's show, we dug into that. So to go back to yesterday's show, if you want a little more detail on the resistance and why that played out. But I want to focus on what's happened now. We've broken below the 50-day moving average. We've broken below the swing lows from December. We've now broken below this level here, which is a big round number, 40,000. Now, as we continue lower, what sort of downside objectives can we expect? Well, number one, I'd be watching the momentum, which is certainly in the bearish range, right? The RSI has broken below 40, so I didn't put the little red shading here, but I probably should because I think this is now telling you Bitcoin now more in a primary downtrend as opposed to a primary uptrend, which probably ended there in mid-January. And sort of downside of objectives, I would keep an eye on 36,000. That would be the Fibonacci level. So the top here in 49,000 is the 61.8% retracement of the way all the way back up from the the 22 low to the 22 high. The 38.2% level is around 36K, which is right around there. That's just above the 200-day moving average. That might be the initial level that I would look at. You can also apply Fibonacci retracements on a shorter term time frame. So maybe the September low and the January high, and you look for some secondary support levels on the way back down there. But for now, I would say based on the breakdown in price, the breakdown of the 50-day moving average, the momentum getting more negative, I think the path of least resistance for now is lower on Bitcoin. Look for signs of stability. And full disclosure, I do own Bitcoin and some personal accounts. But overall, short-term weakness, I think, is the story here. Let's look at some individual names to round out our market recap. There's some gappiness that we're going to talk about based on earnings. Logitech, one of the names reporting here in the last 24 hours, gapping down to around 85. Yesterday's close was around 96. We're down about 11.5% today. It bounced up a little bit there going into the close, but the damage sort of done. Now, this is a bit of a doji candle, meaning the open and close are right at the same levels. Anytime there's a gap like you see on Logitech, I would say the next move is really important, right? Because one of two things is going to happen. Either investors love the opportunity to buy Logitech at a discount from where it was trading on Monday's session. They love the idea of getting in around $85 a share, and we start to bounce higher from there and start to fill that gap. Or people recognize that the negativity as expressed in this gap lower is just the beginning, and that the prospects that we had for Logitech may be a little bit unfounded, and you see further deterioration. So after you have a gap, what happens sort of immediately after that, often really telling about the conditions and sort of the mental state of investors. This is one of those names, by the way, that had a clear bearish divergence going into today's trading, right? Higher highs December and January, lower peaks in momentum. This is a warning sign we talked about on some of these tech charts, really playing out as you might expect on the chart of LOGI, Logitech. Looking at the industrial sector, we have some defense and aerospace names reporting. Lockheed Martin pushing lower today, about 4%. This puts it back below the 200-day moving average. It broke above there Initially back in October, early November, sort of traded around the 200-day, and then early January, all of a sudden felt like a pretty constructive breakout, making some higher highs above the swing high from November. Today, kind of right back down to earth, and now testing the lower end of the range. It's worth noting it traded below the 200-day, traded all the way down to around 433, 434 before closing right back at previous support. So I'd be watching this 438 to 440 range. It's literally right where we closed today. I would be interested to see if buyers come in through the course of this week and are able to push the price above the 200-day moving average. I would personally be patient to wait to see if that accumulation actually follows through. That's the place I would be concerned is if we continue this trend below that 438 to 440 support level. RTX is Raytheon Holdings, an aerospace name in the same sector. So just as LMT gapped below the 200-day, Raytheon actually gaps above its 200-day moving average today, up about 5 1/3%. Gapping above the 200-day moving average, gapping higher, closing higher, and also getting above this level. We're actually in the middle of this range now. This gap, by the way, from July of last year, that went from around 86 up to around 94. Today's move actually puts us in the middle of that gap and breaking above that resistance level here around 86 to 87. That's a clear breakout level. That's a level of potential support. The 200-day moving average is there as well. But for now, a nice gap higher, potential upside follow through to be had. Consumer staples have not been a particularly strong sector in the last 12 months, if not earlier. On a relative basis, it's been pretty rough, especially some of those areas like food products, which have been absolutely brutal. Charts, ADM, and names like that come to mind. Procter & Gamble actually gapping higher today on earnings. You can see PG up about 4%. That takes us above 152. We gapped above that resistance, and on a chart like this, I basically, my general assessment, again, just on the chart that I'm looking at here, is a gap above resistance is bullish. That breakout level around 152, that's your built-in stop. So as long as we hold that on any sort of pullback here this week, then that's still a pretty good breakout. I'd be watching those previous highs around 156. We traded up there today, but that breakout was repelled. So either we break to a new high, which would be pretty constructive, or we failed to hold that breakout, 152. So that's a good opportunity to use the alerts on stock charts. Over 156, pretty constructive. Below 152, not so much. And wait to see which of those alerts triggers first. Same sector, actually different sector, sorry, but a similar gap higher. Brown & Brown, BRO is the ticker, BRO. If you look, this one, same thing, gapping above resistance. So these types of charts, I would argue, on the surface level, pretty constructive when you have a big gap higher. This one's actually trading lower through the course of the day today, still up about 5% from yesterday's close. We'll see if there's further pullback. 76 is sort of that upper end of the range up until today. So that's an area I might potentially look at. We highlighted home builders on the chart on the show yesterday. I want to highlight DHI, which reported earnings before the open today. Not great. So the stock was actually down almost 10% today. Tested the 50-day moving average almost to the penny. Ended up closing just above the 50-day. Now, this is similar to Logitech, right? Up until today, we had that bearish momentum divergence. And this is why charts like this go on my red flag chart list, which is, stocks that are still going up, but I'm seeing some signs of concern underneath the hood. With a chart like this, the bearish divergence suggests an exhaustion and upside momentum. Today's gap lower pushed it also below the swing low from earlier this month, and now the 50-day is in play. I think the big question for DR Horton and really ITB, the home builder ETF, do we hold the 50-day? Do we hold that swing low on a pullback? And a lot of these names have had really good runs off of the October low, handily outperforming the S&P 500. Do we hold the 50-day on this gap lower? That's not a great look coming off of a new 52-week high and then gapping lower. That suggests that the earnings today really quelling a lot of that or squashing the optimism that we had up until today's report. Look to see if it's able to hold that 50-day. I'm skeptical of its ability to do so. That is our market recap. I'm going to bring on today's guest, Ari Wald of Oppenheimer, here in a moment. Before I do so, just a quick announcement. We would welcome your question. Our mailbag is a lot of fun to dig into. We've had so many thoughtful questions from all of you. I'd ask you a couple things. Number one, email us your questions. thefinalbar@stockcharts.com. Anything about technical analysis, the Stock Charts platform, investor psychology, sentiment, breadth, whatever it is, we're here to point you in the right direction. On X, just tag us in a comment @FinalBarSCTV. And on our YouTube channel, of course, make sure you like and subscribe to our channel. Just drop a comment below the video that you're watching. Always helpful if you put a link, a permalink, to the chart that you're referring to on Stock Charts. That helps me see exactly what you are looking at when you ask your question. I want to welcome on today's guest, Ari Wald. Ari is the head of technical analysis at Oppenheimer, coming to us from New York. Ari's been a frequent guest on the show. Happy New Year, Ari. Welcome back to the show. How are you?
I'm great, Dave. Always a pleasure to be on there. Yeah, thanks for having me back. Good to see you.
No, I appreciate it. And thanks for coming on a number of times last year. Really helpful along the way during a challenging at times 2023, getting your take on things. Now I feel like we're setting up with a, sort of an optimistic feel to the markets, I guess, right? Since the October low, we're seeing a nice rally. S&P new all-time highs here in the last week. We're looking at your first chart, just thinking about valuations. When you look at this environment, what stands out to you?
Yeah, so our take on valuations is really based on how the bull market is unfolding versus bull markets past. Now, for starters, in our big numbers for the year report, we laid out the case that the S&P 500 is conservatively undervalued below 5,400. Now, first, in terms of getting to 5,400, that would equate to a 13% gain from current levels where we were at the start of the year. And that we get to that based on typical year two performance of a bull market cycle. We get to that number if you look at performance following a breakout to all-time highs. We get to that number based on another study we did looking at performance following a flat 2-year period. So from a variety of these studies would suggest 13%, 5,400. Now, the claim that we're conservatively undervalued below that level is looking back at all bull market cycles since the 1930s, the median gain has been 70% bottom to top. If we then look at the 10 shortest and most muted bull market cycles, which is what we're graphically showing here, that median drops to 60%. So S&P 5,400 would equate to 50% bottom to top. Why we think that based on historical precedents, this cycle has room to run. We're also showing that 70% of the cycle, 16 out of 23, did make it to their 2-year anniversary. So added up and historical probability suggests that this cycle can continue into at least the fourth quarter.
It's so interesting as we've seen the strength off the lows, and I appreciate this idea about valuation. So many have obviously argued the opposite, that we're overvalued at these levels. One of the concerns people have been the arguably overheated breadth conditions, as breadth indicators have started to spark higher in the fourth quarter. When you're looking at breadth, though, it seems a little more constructive long term. Can you talk us through your second chart?
That's right. So we laid out the roadmap based on historically how these cycles unfold. But of course, we're going to be keying on our primary indicators to either confirm that roadmap or deny it. And right now, we'd argue that the indicators are confirming it, that we've seen this directional improvement in terms of internal breadth. And the particular indicator we are charting is the percentage of NYSE stocks above their 200-day average. And what's notable about this is if you look at forward returns based on the level of this measure, it's an asymmetrical payoff, that the higher forward returns are when the reading's very low and also very high. That low readings, those are your market bottom conditions. And then conversely, readings above 70% typically confirm your broad-based breakaway and a bull market that should continue. And then the third signal is the market top signals when you get new S&P highs and this indicator fails to get above 60%. And I'm showing that has marked, I think 5 out of the 6 market tops going back to the 90s. The 2020's COVID peak was the one it didn't really capture. And so currently right at 69%, I'd argue it hasn't quite gotten to where we want it to be. We still need the Russell 2000 to break out from its 18-month range and get that real big explosion in breadth, but we're pretty close. And as it stands, it's not weak enough to suggest a market top at the very least. So, so far, as it stands, confirming our year 2 bull market cycle view.
You mentioned small caps there at the end, and certainly small caps range bound last year, but sort of at the upper end of the range, arguably starting to break out. A couple days out of the last week, you've seen small caps outperforming large caps. How important is it, in your opinion, that small caps start to participate in the upside, maybe more than they have here going into continuing in the first quarter?
Oh, without a doubt, we want to see the broad-based leadership. But the nuance there, and you asked it the right way, they have to participate. They don't have to lead. That we continue to discuss the differences between absolute participation and relative leadership. I'm fine with small cap underperformance as long as they participate. Throughout the 1980s and 90s, it was a large cap led bull market. I think large caps can lead in a secular bull. We've seen it before. Small caps still have to participate. So once again, to come into the year, this Russell 2000 was rebuffed at that upper end of the range there. We need to see that breakout if there's going to be some staying power to this upcycle.
You know, your third chart, Ari, talks about sort of the gap between the winners and the losers, or the leaders and the laggards. Can you talk us through what you're showing here, what it tells you about the conditions going forward here?
Right. We've had a bit more of a differentiated take on the growth versus non-growth divide. We agree the divide is as extreme as it was in the late 1990s, where we disagree is the driver of that imbalance and the market implications. In our view, we've continued to argue that the steadiness of growth in the NASDAQ 100 is actually underappreciated. If you look at the long-term rate of change of the NASDAQ from where it was now in the 90s, apples and oranges comparison. Instead, it's been just how poorly the rest of the market has done. So in this case, we are graphically showing that by looking at the long-term annualized return of the best and worst performing sector. And what we're showing here is that the top sector, technology in this case, has posted returns that are nowhere close to what we saw in the late 1990s or even the 50s and 60s as well, when those two secular bull markets peaked. That instead, it's just how poorly the bottom sector has been. It's closer to major low points through history. All this means that if there's going to be convergence, more likely to be driven by catch up rather than catch down. This is why we think the market is positioned to surprise higher in 2024 and even beyond is that catch up potential. As far as where you want to be, however, I would still side with the relative strength and the leadership. But again, I think it's there is still that potential for middle inning secular bull if we can get some of these lagging areas to act better.
Ari, so you mentioned sort of the gap between the leaders and the laggards, a potential catch-up trade. How do you think of some of these leading growth names that are continuing to press to the upside? I mean, really dominating returns, continuing to dominate returns, I guess, in the first quarter. Meta, Alphabet, and these others. Are these the types of names you think still deserve a spot in a portfolio, or are these the sorts of areas you would be lightening up, given the potential uncertainty, given the run that they've had so far?
Well, Dave, I'm an advocate for the momentum factor and the rules of momentum investing. Let your winners run and cut your losers quickly. These are winners. No, these, in our view, this large cap growth should remain a core position. We believe these have been drivers of the secular bull market. We believe the steadiness is underappreciated, and I think they remain leadership. I think as an attractive in between, our top rotation idea is actually mid cap growth, because I think it strikes that balance between that long-term secular growth leadership and the intermediate-term rotation potential that we see in lower capitalized stocks.
It's interesting as we're reviewing the charts here, and again, you have a really well designed process of reviewing all the evidence, which I've appreciated following over your career, Ari. But as you think about the conditions that seem constructive here, what would tell you that the conditions are starting to turn? Like, what would you see on any of these charts that we've looked at, or maybe something we haven't looked at yet, that would be a red flag of, this is starting to get a little more defensively minded? Is there a chart or a level you'd be paying attention to?
Sure. Well, first, as far as the classic roadmap, we'd be more on market top watch come the third year of the bull cycle, especially as we post into this post-election year, as we've tracked the typical the 4-year equity cycle has realigned with the presidential cycle. But even if one develops before that, we'd be looking at internal breadth. Would we start to see breakdowns in pockets of the market, a sector culprit, a new S&P high undermined by a real more notable bearish divergence in that 200-day participation indicator? And I'd be looking for leadership to turn as well, seeing a move towards low volatility, counter-cyclical defensives utilities and consumer staples. We're not seeing that. We'd expect to see credit spreads start to widen. We're not seeing that either. So those potential warnings we'll be watching. As it stands, not there.
Yeah, it's really interesting. I mean, I feel like we continue to wait for utilities, staples, those kind of areas of the market to improve. You just haven't seen that, particularly on a relative basis, right? Continuing to underperform. Can we talk a little bit? We were talking before the show about volatility. The VIX, of course, remaining quite low between sort of that 12 to 14 range. When you think of volatility through the course of 2024, what would you need to see on this chart to tell you conditions are evolving? Is there a level or a pattern that you like to follow on the VIX that tells you things, the fear gauge, or I guess the fear is starting to be a little more palpable?
Great question, because, you know, it is a contrarian indicator. It's not that low readings are bad per se, however, that, you know, we found that low readings are a function of a bull market, and it's confirming the market that we're seeing. Low readings as it stands might not necessarily indicate that conditions are tactical for purchase, but it's not a reason to sell either. You still want to buy stocks. The opportunities are when you get a spike in the VIX, it's an opportunity to buy stocks. But if we do see, you know, through the course of the year, a higher range of the VIX, you know, that could be indicating that the character of the equity market is changing into ultimate reversal into a bear market.
I'll ask this question, Ari, because you're one of a few, but I guess growing group of professional analysts that hold both a CFA and a CMT. So you're familiar with the economy and the fundamentals, and I think you could talk the talk probably better than anyone. There's been a lot of debate, obviously, about the Fed in 2024, the idea of a recession and what that means. How do you reconcile, I guess, concerns about a recession in sort of this Goldilocks scenario versus what you're seeing on the charts? How do you make sense of those, you know, potentially competing inputs going forward?
Right. Well, first thing to note is, and we remind clients that the equity market, the S&P 500 is the discounting mechanism. It is the leading indicator. I'll tell you where the economy is going to be based on the S&P 500, not vice versa, based on rather than using economic indicators to predict the S&P 500. S&P 500 is indicating, as it was throughout 2023, that recession risk is not imminent. You know, with that said, the one study that does give us concern is based on forward returns of the equity market when the yield curve is inverted and the last Fed policy action was a cut, actually. That the market has shown negative 12-month returns when that's the case. So be careful what you wish for. You know, thinking about the Fed, I don't think they're going to be in a hurry to cut. They want to avoid the 1970s roadmap where they arguably cut too quickly and inflation came roaring back. By the time they cut, which rhetoric would say would be a market positive, I'm almost going to be concerned. Why are they cutting? Probably because at that point, economic activity would be deteriorating. So kind of how we framed it, you know, buy the speculation, sell the news. You know, the market is rallying in anticipation for that cut or for the fact that they paused and stopped hiking. But by the time they actually cut, that could be closer to that market top condition.
That's a brilliant answer, Ari. I'm not surprised because I trust you to give a great answer to that question. You came through as expected. Good to see you. Listen, great charts. Thanks for sharing some market wisdom with us. Best of luck and much success in 2024. And we'll hope to have you back again soon.
Can't wait to be back anytime, Dave. Thank you all.
That's Ari Wald. He's the head of technical analysis at Oppenheimer, just a fantastic strategist, and really love it. If you heard his answer to that last question, there's a lot of wisdom in that, right? So many people think of economic conditions and economic data as a way to think about what the markets may do next. And what Ari very rightly pointed out is that the cause effect or the relationship is actually flipped, right? You look at the stock market to get insights on the economy because it is a pricing, it's pricing forward expectations. So best thing to do to get a sense of economic conditions, follow the markets. And I thought some really interesting comments there as well about the VIX, about valuations. And conversations with Ari remind me to think about the long term, some of the long-term implications, quite bullish about some of that evidence we were talking about. Great take there by Ari Wald of Oppenheimer. Now let's get to the 3 in 3, 3 charts in 3 minutes that tell the story of this market environment. Here is chart number 1. We're looking at some of the leading growth names: Microsoft, NVIDIA, Alphabet, Meta, names I am quite certain you are familiar with. And I talked with today's guest, Ari Wald, about the leadership, and his comment was essentially stick with what's working, right? Go with the names that are performing well, particularly on a relative basis. Go where the momentum is, go where the flows are. And I would say these 4 charts, all bullish, right? I mean, and that's not a judgment call. That's not me saying a recommendation of what I think NVIDIA is going to do. It is an objective analysis based on the trend. The trends are bullish across the board here. And I would say that for a couple of reasons. Number one, the Charles Dow basic trend analysis. All of these charts are making higher highs and higher lows. Number two, we've recently broken out. I have these purple sort of horizontal lines highlighting recent resistance that each of these stocks has now eclipsed in the last month or two. So we have had a ceiling, we've had a reference point, a resistance level. We have pulled back from there, and now we've resolved to the upside. It's bullish when charts break out, and while we can talk about how overextended or overvalued they might be, I have seen way too many times where investors sell way too early and leave some of the best gains on the table. So charts that are breaking out, I like to define a line in the sand. Look for a level that would tell you that conditions are changing and that you need to start getting more defensive. I think with any of these breakout names, a simple look at the breakout level to see if they're held on any pullback soon after the breakout, something like Alphabet 140, that would be the level that I would probably be watching. Drawing trend lines off of these previous lows, because all of these charts have trend lines that have not been broken yet. You can draw some simple trend lines. As long as we hold that trend line on a pullback, it doesn't tell you necessarily to buy or sell. It just tells you that the trend that has drove that breakout is still in play. So all 4 of these charts, I would argue, still up and to the right, long and strong charts until proven otherwise. Chart number 2, Bitcoin. We talked in our market recap about cryptocurrencies obviously rolling over since the ETFs were announced here a couple weeks ago. I wanted to, I shared earlier, sort of the longer term framework, looking at the 2022 high and low as a way of framing out the Fibonacci retracements. Here we're looking at a shorter term time frame. You have to remember that Fibonacci retracements can be used on multiple time frames to get longer term and shorter term levels. When you look at the September low, which was the lower end of this base, when Bitcoin bounced off of 25,000, you see the rally to around 49,000 that we achieved here in the last couple weeks. Now we draw the Fibonacci retracements between those two extremes. 38.2% of the way down is around 39,800. Just today and yesterday, we have now broken down through that level. That's also 40,000, a big round number. So what's next? Fibonacci analysis would tell you just below 37K would be the 50% retracement level. And then the main next level would be 34,050, we'll call it, just above 34,000. That's a 61.8% retracement of the way back down to the September 23 lows. You can also see that's the 200-day moving average. And so we have what's called a confluence of support. I wouldn't be surprised if that ends up being the next downside objective before a recovery, really a lasting recovery for Bitcoin. But let's continue to watch that trend. Finally, a chart like Netflix. Netflix reporting after the close today. We don't have time to update what the report was and look at the after hours trading, but going through the remainder of this week, I think it's a big question mark. We saw today names like Logitech and DR Horton and others gapping lower on an earnings miss. If Netflix has any issues with their earnings, we are testing resistance. So we gap higher. This is a breakout out of a great basing pattern, right? Sort of a renewed optimism if we go higher. However, the momentum has been quite negative. So new highs in November, December, and January have been met by a weaker RSI. That suggests to me caution should be something to think about. Keep an eye on moving average support and trendline support around 400, quite a ways below current levels, but maybe where things retrace if earnings disappoint. Folks, that's a wrap for the show today. I want to thank you so much for joining us every weekday after the close for the final bar. A special thank you to Ari Wald of Oppenheimer joining us from New York. For Stock Charts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night.